Hi. Baron Rothschild once said, buy on the sound of cannons, sell on the victory trumpets. In simple words, buy when it seems foolish to buy, sell when it appears idiotic to sell. But buy what and where? Which brings me to the topic of investing in foreign country stocks. And for this, we have to go back a little in time. In the early 80s, when I was still a value investor by numbers, that is before I began sleuthing, I once found a foreign stock of a key industry priced ridiculously low at an enterprise value to EBITDA, earning before interest, taxes, depreciation, and amortization of 0.5. Yes, the market cap plus debt was half annual cash inflow, half. Normally, this ratio is 5 to 10 times for a normal company, or close to 20 or even 50 for crazily growing companies if they have positive EBITDA at all. Which stock was it? The stock was the Argentinian telephone company's symbol TEO. Argentina was then sunk in a political scandal, theft by corrupt officials, generals killing leftist students, government bonds going no bid. In short, Argentina was a mess. So was the stock market. What I figured, though, was that Argentina, where I had some business school friends, was second in South America in its importance to the US empire, only to Brazil, Mexico being a mini empire of its own, mainly of drugs. So I figured the CIA wouldn't let Argentina go bust. And surely I figured Argentinians will still use phone in the future. So I looked at Theo, I took apart the balance sheet, it was good, checked the main customers, also good, asked local friends about managements, they came out fine as well. So and I realized that the problem was the country, not the company. So I bought some stock, a little less than $2 a piece. Or rather, not the stock directly, but its ADRs, the American Depositary Receipts, which are the stock twins trading in the US. The result? Within a year and a half, the stock rose to 3, and so I sold, thinking myself a genius. And of course, I told everyone. Wrong move, both. Why? Because after I sold at 3, the stock rocketed to over 20. Since when the country turning normal again, Theo soon became valued like a normal utility at 10 times EBITDA. So yes, I got a triple, whoopee, but I could have had a 20 bagger. And because I boasted of it, I couldn't hear the end of it from good friends. Yes, we all have good friends like that. Now what's the conclusion? Besides not being arrogant and letting your winners run. It's this. If a good country looks bad temporarily, sleuth how really bad it is by talking to citizens there, preferably friends. Then, if your optimism survives, pick 1 or 2 several companies there, sleuth them out too, buy the stocks, and wait for better times. No hurry. Now, before I go into who taught me this, there are 3 important reservations to the above. First reservation. Stay away from foreign banks, foreign insurance companies, because you never really know the debts of the former to corrupt politicians or the long-tail obligations of the latter. Second reservation. The country must have a functioning stock market and a reasonable chance to be free of socialism. Third, and closely allied to the second, the country must be a democracy, not a dictatorship, and this must include functioning law courts. And just before we go to the sidebars, the country I have in mind here is India, in which one stock in particular stands out. I'll talk of it soon. Now 2 sidebars. First, I may occasionally have positions in stocks or securities I mentioned. Second, I must give credit where it's due. And here is to Jim Rogers. You see, in the 80s, when I became a director of research of a large Canadian brokerage company, I felt I needed to meet as many investment geniuses as possible to learn from, and Jim Rogers was then teaching at Columbia in New York City. I had read Jim's book, Adventure Capitalist, loved it, so I wanted to hear more from him in person. So I flew to New York City and sat in his class quietly, just listening, to listen to him talking. What I didn't know then was that years later, I myself would give a lecture in Columbia in the very same building after my own book, The Sleuth Investor, appeared. But it's another story for another time. Anyway, in his class, Jim Rogers was expounding on the merits of researching what no one else wants to look at, same as what Baron Rothschild used to say. And I also remember him mentioning in the class nuclear utilities, which in retrospect was bang on prophetic because they all rose a lot. But he also recommended looking at good countries that are temporarily on the ropes, and the idea stuck in my mind, which brings me back to India. You see, almost all countries now are more or less in trouble following the virus and the economic lockdown. But India, with more than 1 billion people in population, is in particular dicey spot. It has 120 million unemployed, a third of the US population. And because of its many slums, there are some difficulties in eradicating the virus. So like most other countries, its stock market is down. But India is a British-style democracy, although it's tied up in bureaucratic red tape. And it has some other problems. But because parliament works, the problem, in my opinion, will be fixed. And because the law codes work too, this means that property is still property, so stocks are less likely to be confiscated from you. Now, are these the only reasons I think that Indian stocks are the devil look? No, for two more reasons. First, India has a border war with China. And second, India has a lot of really smart, educated people. Let's take the war first. You see, the US now needs allies in its coming conflict with China and will pay for this help. Of the very few countries with size that can be candidates for this, one, Russia, has its own dreams of empire and is already allied with China. But India, 1 billion plus in population, is a regional power and an opponent of China already and has also come to blows with it on a joint border near Tibet. On a human level, I don't like the conflict, but on a stock level, this, in my opinion, makes India the likeliest natural candidate for an Eastern partner ally of the US against China. And this would give it a great advantage in bouncing back from its problems. Because whatever temporary problems India is now going through, the US will help it resolve eventually just to buy its loyalty, either by forming special trade agreements, or by helping India make armaments, or by bringing India into the recently formed Space Consortium. See my previous clip about Boeing, which, by the way, has doubled already since. Or by giving Indian industrialists fat contracts to help sway the government to the US side. You know, just a normal bribe that empires give and take in the global battle for power. Which brings me to Vedanta, the Indian company with the symbol VEDL. Vedanta is based in Mumbai, on India's west coast. It's a large, well-diversified company that explores for and produces zinc, lead, silver, oil and gas, aluminum, iron ore, and probably a few other metals I forgot. It also operates power facilities in the seaport, manufactures steel, glass, medical equipment, and much more. In other words, it's a big part of the Indian economy. Just how big is it? Market cap is about $6 billion. Enterprise value, that is market cap plus debt, $7.5 billion. It's big. And by the way, it was started in 1965, so it's 55-year-old now. Not a newly hedged IPO, so it's likely to survive. But how expensive or cheap is its stock? Here's the rub. In my opinion, the stock is extremely cheap. Trailing price-earning multiple is 6, single digits. Forward price-earning multiple on forecasted earning is 5, dead cheap. Price-to-book value is 0.4 times. That is, it's trading at less than half book value, a giveaway. As for EV to EBITDA that I mentioned before, it's even less than Teo when I had bought it. What are the negatives? Yes, there are a few. The obvious first ones is that on all normal measures of governance that shareholders advocates follow, the company comes up weak. Board supervisory is seen as weakest with 9 out of 10. Audit quality is a weak 8. Shareholders' right equally weak at 8. And compensation is 6, which means that financials are seen as only partly trustworthy. Management seems to take care of itself before they take care of you. And they also overpay themselves, apparently, based on observers' viewpoint. But the silver lining is that because of the less than stellar stewardship, the stock is extremely volatile. At the cycle's bottom, it tanks a lot. But when good times roll, as they usually do, it soars a lot. It has done this several times. Where is it now? At the bottom or close to it? It's close to the bottom. The previous cycle, Vedanta went down to $2.70. Then it rose to 18, which is like 6 times. In the recent market plunge, it fell to 324 at the bottom and then popped recently with the market rise to 585. But it's still well short of the previous peaks, short of 18. Can it back Can it get back to the former peak of 18? Let alone the all-time high of 32? Who knows? Don't forget, it may also plunge first back to the bottom of 324 or even lower still. The risk can be halved from here. But eventually, my speculation that it will rise again toward the previous peak, having the all-time peak. What I like especially is that the companies in the commodities and metal business, which are good for the coming inflationary times, I like the stock cheapness, and of course, it's dividend at much more than 3%, 3% yield. And yes, India, as I said, is full of very smart people. It is an ongoing source of engineers and programmers for Silicon Valley. It has launched rocket and satellite into space very cheaply, and I mean cheap. And as a former rocket scientist, I know what cheap is in aerospace. And by the way, India also is a nuclear power. As I said, very smart people. The symbol of Vedanta, as I noted, is VEDL. Once again, just to make sure you understand, the above mentioned is not a recommendation, not a stock tip, just an example of how to go about looking for a cheap foreign company in a temporarily out-of-fashion country, which on top is also at the right industrial areas at the right time. That's all for now. Let me know below what you think of it. And if you like it, give it a like. Subscribe, and then tell all your friends so they can subscribe too. See you next time. And meantime, thank you very much for watching.